Hey everyone, it is KF here. Today's video lesson is going to be about risk management. This is a must watch for new traders. So before you click to the next video, I strongly encourage you to take some time and watch this video. It's going to break down how you can safely trade, how you can safely learn how to trade without risking losing your portfolio and things like that. Obviously, there are risks in all sorts of trading. You are risking losing money, but some of these, tips and techniques will help you minimize those losses that you face, especially while you are early on in your learning process of learning how to day trade or swing trade or whatever kind of trading it is you are interested in. So I want to talk about this idea of finding your full size. Now, what I mean by full size is that you should find an amount of money that you're comfortable risking on every single trade. And you need to use that same amount of money on each trade. So a lot of times people will ask me and they'll say, how many shares do you buy of a stock? Well, it totally depends on what the price of the stock is. If it's a $1 stock, the amount of shares I buy of that stock will be very different than the amount of shares I'm going to buy for a $10 stock. So for some reason, new traders seem to have this question a lot, and it's really important to grasp that you don't just buy the same amount of shares for every stock. Okay, it needs to depend on, in this case, what I mention here as your full size. Okay, now here's some tips to finding a full size for you. You'll see this table I have here at the bottom. If your account size is $4,000, so you have 4,000 total dollars to trade, well, then I suggest that your full size is about half of that, which would be about $2,000. Now you'll see that I'm a little bit more aggressive with the percentage of my overall account that I would use for my full size earlier on, and I'll explain that in a little bit. But it helps with compensating for different for commissions and things like that. You want to be a little bit more aggressive. So if you have an account size of about $4,000, I would encourage you to take about a $2,000 size of each position you take. So if it's a $1 stock, that means you're buying 2,000 shares. If it's a $10 stock, that means you're buying 200 shares. And I'll explain that more in a little bit. Now, I also have mentioned here a half size. Now, knowing your half size is also very important because there are certain trades and certain techniques and certain patterns that will want you to only enter a trade half size initially or just half size at all. For example, there are times if I'm trading a very, very volatile penny stock that's 40 cents, which I don't trade a ton of stocks like that, but if it's very, very volatile, well, in that case, I will go in half size rather than full size so that I can give it a little bit more room to move around. Again, I'll explain that a little bit more depth, but just knowing the difference between full size and half size is important. So hopefully this table makes it clear to you the differences of those. Now, over on the very right side, you'll see I have money in MF. MF stands for mutual fund here. And this is just a technique that I encourage new traders to use, especially new traders who are starting with larger accounts. If you're opening up an account with, $25,000 or more, that puts you over the pattern day trader rule. Well, in this case, I would definitely encourage you to take a portion of that money and go ahead and buy into a safe mutual fund. That way, you still maintain that money is still going towards the $25,000 required to day trade, but you're less tempted to take sizes that you shouldn't take. You're less tempted to take, go all in on a stock, especially while you're learning and while you're still trying to figure out how to handle your emotions and things in trading. So this is kind of a safety net that I encourage new traders who are just recently started trading and have money more than $25,000 that puts them over the PDT roll. I encourage you to take a portion of that and go ahead and put it in a mutual fund for a little while until you really feel comfortable and are ready to take a little bit bigger sizes. So here, if your account size, if you have $30,000 to trade, well, that means you have about $9,000 full size, and you can go ahead and tuck the rest of that money away into a mutual fund. That's just a suggestion, especially for new traders. I would strongly encourage you to try that out. Because I can't even tell you how many times I've talked to new traders who, will start off, hey, I have $30,000, I'm over the PDT roll, I want to trade, and they overtrade and overtrade and overtrade, and then they, get caught bad in a stock and decide to go all in and average down, and just like that, within 2 weeks, their entire portfolio is ruined. So while you are learning, I do encourage you to, kind of have that safety net of potentially putting money in a mutual fund to begin with. Now, I just want to stress this again. It is so critical to use the same amount of capital each trade, okay? Do not bounce around. You don't want to take a $2,000 risk on one trade and then a $20,000 risk on the other trade. And the reason for that is because, if you learn how to trade correctly, you should be profitable on anywhere from 70% to 80% of your trades. And so that way, with what I'm going to talk about in a little bit, having a good ratio, risk to reward ratio, If you are following your rules, then you will be a profitable trader. But if you're bouncing around, taking $2,000 trade here and a $20,000 trade there, well, you could be you could have a success rate of 99%, but if it just so happens that you go all in on one stock and you do lose on that stock, that's going to wipe out all of your previous gains. So it's really critical to use the same amount of capital each trade, have a really strong base amount that you use. Now, how do you know how many shares to buy? So this table at the bottom will help illustrate that. And here's a little bit of a formula to help you figure out how many shares you should be buying of each stock. So in order to find how many shares you want to buy, you want to take your full size. So let's use the example of if your account was $4,000, like I mentioned here, if you have an account size of $4,000, that means your full size is $2,000, you can see there. So if your full size is $2,000, you want to take the $2,000 there, divide it by the share price, and that's going to equal how many amount of shares you're going to buy for that stock. Now in the example that I have listed here, if your full size is $5,000 and the stock price is $3.50, you're simply going to take $5,000 divided by 350, and that's going to give you how many shares you should buy of that stock. So you'll see this is why it changes with each stock. Just be very careful. Don't just blanket buy the same amount of shares for each stock. If you buy 100 shares of Amazon, you're investing, $100,000. But if you buy 100 shares of a penny stock, well, then you're only investing $100. So the risk reward there is very different and can be very extreme and can really get you sideways if you're not careful. So here's some examples here. I have listed there, if you full size $2,000 and the stock is going at $1.20, that means you want to buy a little over 1,600 shares of that stock. Same thing, if your full size $2,000, the share price is $6.85, that means you want to buy almost 300 shares of that stock. And of course, that's going to increase as your full size gets bigger. So go ahead, take a picture of this, screenshot this if you want to use this kind of as a general rule there to refer to. Now, risk management, as I mentioned. When entering trades, you need to be very careful that you have a 1 to 2 risk to reward. So you want your potential reward money to be made on the trade to be twice as much as you're willing to lose on the trade. And again, as I mentioned before, if you're winning between 70 to 80% of your trades, which is about where you should be as you slowly develop into becoming a profitable day trader, then in that case, you're going to be profitable because you're following these rules. On your losing trades, you're only losing half the amount of what you're winning on your trades. Now, this is just an example. You'll see here I have 2% to 4%. That's just an example of a good risk to reward ratio. But that could change. Maybe your risk to reward style is more like risking minus 5% and gaining 10% on a trade. Now, again, this is only of your full size. It's not of your entire portfolio. Okay, so keep that in mind as well. But this is just an example here. So using the 2% and 4%, this is your potential loss and potential gain on any winning trade or losing trade as long as you follow that. So you'll see your losses are going to be half of what your potential gain will be if you follow that risk to reward ratio. Now, there's techniques making sure you're getting into trades that will provide a good opportunity and possibility to give you that risk to reward ratio. It's not just any stock you buy, you only want to sell for double what you're willing to lose. No, because some setups won't prepare like that. And that means you probably shouldn't be taking that setup. If there's a really awesome setup, but the setup is only giving an opportunity for a 3% gain, and then, there's not support until a 3% loss, well, you need to consider if that's really worth the risk there, because that would just be a 1-to-1 there. So here's another example of if you were willing to risk 5% for a 10% gain, here's an example of what that will do with your potential losses and potential gains there. But the key is to have a 1 to 2 risk to reward ratio where your reward is going to be double what your potential risk is. Now, here's an example of THINKORSWIM and the brackets within THINKORSWIM that I talk so much about in my other videos. And this is why it's so important and so helpful, is because these brackets are just there for you, and you can set them to be, a predestined percentage, where as soon as you buy a stock, you automatically have a take profit cell pop up and a stop loss cell pop up. So you'll see here over on the right side of the screen, that's the active trader within THINKORSWIM. And, if I were to buy the stock at 372 here with 2,000 shares, well, my take profit cell is automatically going to pop up at 391, and my stop loss automatically pops up at 365. So in this case, we're looking at a 5% potential gain here, and then a 2% potential loss. Now, of course, knowing where to take profit and where you want your losses to be at and engaging that, that's totally different in terms of technical setups and learning that. So I encourage you to watch my other videos to get a better idea of that as well. But this is just an example of how you can get your brackets to pop up right where you want them to just by clicking one button there. So I encourage you to watch my other videos as well. My ideal ThinkorSwim setup. I think it's about the 9-minute 30-second mark. If you fast forward into that one, I'll talk about how to set up these brackets here. Now, here's some basic risk rules that you want to follow. Regardless of what your goal is, how tight of a trade you're going to take, how loose of a trade you're going to take. If you're buying a $1 stock and are hoping and confident for whatever technical pattern reason it goes to 110, well, then your stop loss, it needs to be at least half of that or under, which would be minus 5%. But regardless of what you do, you always want to have kind of an emergency stop loss at minus 5%. You should never allow yourself to lose more than 5% of your full size on any one trade. Again, that's not your overall account, that's just of your full size. So regardless of what happens, make sure you always have an emergency stop loss in at minus 5%. Okay, don't let that go south on you. This is a rule I try so hard to keep, and anytime I break this rule, I always regret it. I mean, it's like 9 times out of 10 that when I allow more room to be given to a stock than a minus 5% loss, that I regret it. So I encourage you to have that as an emergency stop loss. Now, I'm not saying that for every stock you ever buy, your stop loss should be at minus 5%. No, it will depend on the setup. Sometimes your stop loss will be at minus 2% if you're looking for a plus 4% return. Or if you think there's a good chance that the technical setup is going to provide a plus 8% return on that trade, then you want your stop loss to be at minus 4% or even tighter. So, and some other things to keep in mind is that, when you're in a stock and you're expecting it to act and behave in a certain way, you're expecting it to pop over a certain level, you're expecting it to get lots of volume in power hour or things like that, then in that case, if stock doesn't do what you're expecting it to do, you really want to consider just getting out early. Okay, not waiting for it to hit your take profit or your stop loss, but instead getting out at break even, getting out for small profits, or getting out for a small loss. Okay, but as long as it's staying within your plan, and this, of course, this comes down to technical analysis, and again, learning that is going to be a huge part of knowing when to lock in profits early, etc. But if it is staying within your plan, then go ahead and be confident with where your stop loss is at. Let it move around a little bit, let it grind. If you're expecting it to be a slower play and things like that, have confidence in your trade plan. Another idea is that I find myself doing frequently, especially in different market scenarios when the market's a little bit more sketchy. The market the last 2 months has been different. We had that flash crash on February 5th, and then throughout March, the stock market was just kind of different. It's been different than it had been the last year or so with the huge run up. So when the market is being a little bit different, a little bit less predictable, I will tend to take half profits really soon. So that means if I have 2,000 shares of a stock and the stock's moving up into my price target range, what I will do is I will take half profits, meaning that I sell 1,000 shares for profit and I continue to hang on to another 1,000 shares. And then I go ahead and put in a stop loss near my entry, okay, or at least make it tighter. So that way I guarantee that it is a green trade. So these are some risk rules to keep in mind there. Now, hopefully this was helpful here. Just to review some things, the brackets within ThinkorSwim are extremely helpful in terms of having your stop loss and take profit already set up for you, knowing the risk management, keeping it 2-to-1 as far as reward goes compared to your risk, and knowing how many shares to buy. Do not buy the same amount of shares for every stock. You need to use this formula. Take your full size, the amount of capital you're willing to risk on any trade, divided by the share price. That'll give you how many shares to buy. And of course, as we talked about here, here's some tips to find a full size. Do not trade 100% of your portfolio. If you have $10,000 in your account, do not throw $10,000 at every trade. I strongly encourage you to do that. So hopefully this was helpful. Please like, comment, subscribe. Also head to my website, kafinvesting.com, and come join us on a free trial. We'd love to have you get in with us.